What the stock market will experience in 2019 is still up in the air. However, it's always best to be ready. Add stocks that can rise in value, even in the worst-case situation, to your portfolio to diversify it. Yes, we are merely discussing the recession. This is due to the fact that many financial experts are currently issuing warnings that growth will eventually start to halt. Let's get right into it. For instance, Bridgewater Associates billionaire hedge fund manager Ray Dalio told CNBC that he believes there is a significant risk of a 2020 recession. Fortunately, Goldman Sachs has employed its analysts. The company just published a report listing the equities it thinks will perform best during a recession. Its approach is straightforward. Look for stocks with explosive margins. The following stocks have one thing in common. This year, all of them are anticipated to experience margin growth that exceeds 100 basis points. Ray Dalio is renowned for his understanding of economic cycles and strategy for managing investments under a variety of market circumstances. Investment diversification across several asset types is a crucial idea. This helps to spread out risk and lessen the effects of a sectoral downturn. A method to lessen exposure to economic downturns in certain countries can include taking into account global economic trends and spreading investments across various geographies. The wealthy investor made the point that when debt makes up a sizable portion of the economy, things tend to go worse faster. According to Dalio, the largest error that most investors make is thinking that investments in markets with strong performance are worthwhile. A solid risk management plan is essential. This entails establishing precise risk tolerance guidelines, reviewing portfolio allocations on a regular basis, and modifying holdings in reaction to shifting market conditions. A recession-resistant approach can include concentrating on high-quality assets, such as businesses with solid fundamentals and robust business models. During times of economic uncertainty, it is typical to allocate a portion of the portfolio to fixed-income instruments and safe haven assets like gold or government bonds. When markets are in a slump, adopting hedging tactics like options or other derivatives can help shield a portfolio from downside risk. An important aspect is the flexibility to alter the investment plan in response to shifting economic indicators and market conditions. It's crucial to remember that any investment plan carries some risk, and past success does not guarantee future success. Additionally, precise tactics may change depending on the objectives, risk tolerance, and market circumstances of each investor. Because margins typically become constricted in a late cycle setting, finding the exceptions can be profitable. In light of that, here are the top 7 equities from the Goldman Sachs analysis. To learn more about the stocks and get a sense of how far analysts think they can rise, they are: Number 1. Dow DuPont, DWP. Dow DuPont Inc., NYSE DWDP, is the largest chemicals firm in the world. It's more than just a favorite stock for Goldman Sachs. Additionally, DWDP receives a coveted top pick rating from RBC Capital. According to Arun Viswanathan, track record and ratings of RBC Capital, we see a re-rating opportunity from 7.5 times to 10 times as DWP delivers on synergies and splits into 3 and ultimately more entities. With its 3-way split, Dow will go back to producing basic chemicals, which is its primary area of expertise. Viswanathan also thinks the business is on track to achieve staggering cost reductions of $3.6 billion and the potential for $1 billion in revenue synergies. Why does this matter? The price of shares is likely to rise. In fact, the analyst's $72 price objective for the company represents a 27% increase over the firm's current price. With an average price target of $75 and an overall street consensus rating of moderate buy, the company has a 33% upside potential. Number 2. Netflix, NFLX. You would not immediately think of the streaming juggernaut Netflix, NASDAQ NFLX, as a recession-proof company. In fact, several analysts think the stock appears to be significantly overpriced. However, NFLX has a very excellent anticipated margin expansion of 235 basis points for 2019, according to Goldman Sachs. In fact, Health Terry, track record and ratings of Goldman Sachs, has a buy recommendation and a bullish $450 price target on NFLX. That was formerly $420, but recently increased. With prices today at $326, this indicates that shares have increased 37% from their current level. According to Terry, a well-regarded expert, the company's content investment yield suggests rising returns. We believe shares of NFLX will continue to significantly outperform as Netflix subscriber ads continue to exceed expectations, and it approaches an inflection point in cash profitability, the analyst writes. Additionally, Netflix receives a moderate buy consensus from the street after a good Q4 earnings release. The financial data showed that global paid sub growth is still soaring. In our opinion, this is growth defined, said Mark Mahaney of RBC Capital. His current price goal is $480 with a potential gain of 49%. Number 3. Xylem, XYL. Water reserves are making a comeback. Although I've previously discussed Primo Water Corp, Nasdaq PRNW, Goldman Sachs today highlights a different water stock. This stock is now trading at a discount and showing strong levels of demand. More than 150 nations are where Xylem Inc., NYSE XYL, conducts business. Customers all across the world can transport and use water effectively in commercial, agricultural, and industrial settings thanks to this American water behemoth. Brian Blair of Oppenheimer says, "We would continue to buy XYL into 2019, acknowledging the appealing water sector backdrop, sustainable/defensive growth potential, and XYL's advantageous competitive position, big installed base with technical leadership. Additionally, capital deployment is optional for XYL." Blair even goes so far as to say that XYL is still in a unique position for future development in earnings per share. The analyst reiterates his $80 price target on XYL, with his long-term thesis still firmly in place. That indicates an upside potential from present levels of more than 16%. Backing up, the average analyst price target is $77, and the general consensus is moderate buy. Number 4. Vulcan Materials, VMC. Analysts have unanimous support for the market at the moment for Vulcan Materials Company, NYSE VMC. What do they both concur on? Buy this stock right away. On VMC, 6 analysts have consistently published buy ratings. With an average price target of $126, there is a 27% upside potential. The largest manufacturer of construction aggregates in the U.S., Vulcan Materials Company, is based in Alabama and primarily produces crushed stone, sand, and gravel. This is all excellent news because aggregates are expected to perform better in inflationary and later cycle settings. These analysts anticipate that the strong demand will persist. That's due to increasing government spending, supported by higher levels of public infrastructure spending at both the federal and state levels. FAST Act. We anticipate that improvements in pricing and margin trends will follow a recent aggregates demand strength acceleration, writes Michael Dahl of RBC Capital. Track record and ratings. His $125 price estimate translates into a mouth-watering upside potential of over 25% and is roughly in line with the street average of $126. Number 5. PayPal, PYPL. PayPal Holdings, Nasdaq PYPL, a pioneer in online payments, is developing into a strong financial services ecosystem. Despite some fluctuation in PYPL stock in 2018, caused by concern around Venmo monetization, the analyst day, and long-term guidance among other factors, 2019 is expected to be a great year. PayPal is still in the early stages of its transformation from button/online checkout company to a global payments platform with a sizable addressable market opportunity, writes 5-star Stifel analyst Scott Devitt. He thinks the company is poised for another successful quarter in 4Q thanks to the record holiday shopping season in the United States and the ongoing strength of its core PayPal and Venmo businesses. According to Devitt, competition across the landscape of digital payments continues to heat up, but we believe PayPal's leadership position, ex-China, in a market with strong tailwinds should support further share outperformance over the next 12 months. He set a $108 price objective for the payment shares with a 20% potential increase, and this assistance is merited. The Street currently gives PayPal a strong buy rating. 9 of the 10 analysts who follow the stock are bullish. While the specifics of Ray Dalio's 2024 strategy are still unclear, the enduring ideas presented above serve as a guide for developing a robust investing strategy. A strategy that can endure the challenges posed by economic downturns includes diversification, risk management, an emphasis on quality, global allocation, inclusion of fixed income and safe havens, adaptability, and hedgehog methods. These principles act as a compass for investors looking to traverse hazy waters and construct portfolios that can withstand the storms of market volatility in the dynamic world of finance. That's it for today. Be sure to check out our other videos, and if you like this video, leave a thumbs up, subscribe, and click on the notification bell. Thanks for watching. Bye.